So today on the show, I have with me Mr. Bobby Larsen. Bobby is a very experienced real estate investor in his own right. And unusually for people that I talk to, he is investing in the Pacific Northwest, not just in the Sun Belt like everybody and their brother. I'm going to really ask him a lot of questions about why he likes that market and what's appealing about it. But Bobby, welcome to the show. I'd love it if you just give a really brief, 30-second introduction for the audience about, who you are and what it is that you do right now.
Yeah, thanks, Jonathan. Thanks for having me on the show. Really looking forward to it. Just real quickly, I've spent the past 15 plus years in real estate, both on the institutional side as well as on the syndication owner-operator side. Started Vandermoor in 2017, and we are active buyers of exclusively existing multifamily properties throughout, like you said, the Pacific Northwest. And now that people are starting to shy away from it, the Sun Belt market. So excited to dive into this.
Well, so you're hinting at something that's of interest to me. You said now that people are starting to shy away from it, you're interested in the Sun Belt. So tell me about that, because everybody has been sort of all in on the Sun Belt for a long time now, and you kind of see the consequences of that happening right now. The effect of everybody piling into a single market or a limited number of markets. Why is it that you're interested in it now? When everybody else was interested in it 10 years ago?
Yeah, good question. And this probably answers a good part about the Pacific Northwest as well. We tend to be counter-cyclical. So when we see a lot of money running into a specific market, we pump the brakes a little bit. Rewind to 2017, just like everyone else, Phoenix was going to be one of our focuses. And it started heating up there. And then by 2020, it's the poster child of the Sun Belt boomtown. And that's when we put pencils down in the market. We said, it's unsustainable. This is too aggressive. We don't want to be there. And we looked for other markets that had attractive in-place cap rates, because with an in-place cap rate, you have downside protection. So we take a very conservative approach. We want to see downside protection as well as some upside. But when markets were trading at 3 caps, we put pencils down in those markets, and we went to other markets like Portland, which was a 4.5 cap or 4 cap at the most aggressive, which obviously has its headline risk. We don't buy in the urban core, so let's keep that in mind. But the suburban markets were very attractive, and they provided the downside protection that we look to.
So I mean, Phoenix, I've had sort of debates with people about Phoenix. I'm in a deal in Phoenix, but Phoenix is a market where I've always sort of thought that the economy of Phoenix was based on people moving to Phoenix, right? And the economy of Phoenix is essentially based on building stuff for the people who are moving to Phoenix, and there's not really much else going on. And people are always saying, no, there's more to it than that, but I remain unconvinced. What was it that attracted you to Phoenix in the first place? Is it just the demographics of people moving there, or were there other things there about that market that you liked?
Yeah, Phoenix is probably the market that I've covered the most in my career. Historically, like I said, it was the low cost basis market that new sponsors flock to when they're starting out to build scale. To look at the job landscape behind it, I have to agree with the other people that you've talked to that it has changed significantly. So in the 2008, 2009 timeframe, it boomed because construction boomed. And then from there, it was kind of a cascading effect, because when the market turns south, the first thing that goes is the construction jobs, which then deteriorated the actual overall employment base. Now, fast forward today, they do still have significant construction going on, and those jobs are present, but they've diversified their base, and they're trying to be one of the manufacturing hubs in the United States, specifically with chips and semiconductors. So it's diversified a fair amount. It's had very impressive population growth, probably the top 1 or 2 regions of the United States in terms of population growth, and it still has the affordability aspect. So overall, I think our strategy is not so much of a geographic strategy, but we're looking at population growth, employment growth, and what we love is to find the affordability factor that draws residents to that region. So on the Western United States, again, going back to Pacific Northwest, Portland specifically, we like it because you're getting population growth from 2 of the most expensive regions in the United States, San Francisco and Seattle. And it has the same similar demographics, similar landscape, outdoor enthusiasts that those markets have. So there's a strong draw there. Phoenix specifically, it's almost entirely California. Being based out of Southern California, San Diego, I see it every day. it's very expensive here. And the first place that people look is Phoenix.
So are you, now that the cycle has kind of turned over, are you back looking at Phoenix again now, or are you still kind of holding back before you jump into that market?
We're looking at Phoenix. We are at I would categorize it as the early part of a bottoming out process. So there's still downside risk that we're looking at. And that's for the market, the entire national market as well. So when I say that, we're looking at Phoenix, but we're looking at safer asset qualities. We're not focusing on workforce C-class housing, which is where the most aggressive buyers were the last couple of years. We're looking at well-located, high-quality, newer vintage assets that we think will be very attractive over the next 10 years. And that's going back to just providing some assurances from the downside perspective.
So when you're thinking about downside risk in that sense, and you're thinking about sort of a deteriorating, conditions, are you thinking about sort of the supply demand dynamic, or are you thinking about the apartment market dynamic? So like, which is more concerning to you? Is it the possibility that, your occupancies and rents are not going to be where you think they are because the demand is lessening or there's too much supply, or are you concerned that the market for assets, amongst investors in that market still has a way to run downward? But just, clarify that for me.
Yeah, specific to Phoenix, I would say both, because we do expect a decent amount of distress coming to the multifamily industry, and specifically Phoenix. We've all seen the headlines, I think, so far about the biggest buyers in those markets over the last couple of years. It's in a situation where interest rates have risen so much that they're not meeting the debt service, and they've delayed it longer than we expected, and they're continuing to delay it right now. But make no mistake, there is distress coming to that market. So when that happens, we look at where that distress is going to be, and it's going to be in the workforce housing segment. It's the Class C stuff. So specifically, that answers the first part. Now, the second part is, traditionally, when you do have a downturn in the market, what does the best is Class B plus. It has higher income to rent ratios, and it's more likely that those jobs are not the ones that are lost. So there's more resiliency in the recession.
Yes, I love the fact that you say that, because you've probably heard the same malarkey that I have, that's constantly bandied about, is in a recession, everybody moves to a cheap apartment, so therefore you want to invest in Class C. And that has never made the slightest amount of sense to me, because those are the renters that get hit hardest in a recession. And if you're not laid off, you're not moving, right? If you've got a stable job and you're a Class B plus renter, you're not moving to a Class C property that's beneath your status just because you have some abstract fear that you might lose your job. Or even if you do, you probably have 6 months to a year of salary laid aside, and you're just going to continue renting where you are while you look for another job. Excuse me. So the idea that everyone's going to pile into Class C never made any sense. You've arrived at the same conclusion as me, but tell me what you base it on. How did you come to that conclusion that B is the place to be?
Yeah, I've heard the same thing that you've heard, and I've always had the same rebuttal. I formed my career during the Great Financial Crisis. That is basically where I learned about the industry as a whole, coming out of undergraduate at that time. And I was covering Phoenix. And what we saw was specifically the properties that got impacted the most were Class C studio housing. So the cheapest of the cheap that you could find, which people, by that argument, you would think would be some of the safest because it was the most affordable. The exact opposite was true. That's where the most pain was. And not only was it a vacancy issue, but it was also a collections issue.
Right. Yeah, people, it may not even be that you may be 100% full, but you're not collecting, you're collecting 80% of your rents, and then you have a real problem, right? So
yep.
that's what happens in Class C. Yeah. So, I remember at some point, I don't want to belabor this too much, but I remember at some point hearing this and, going to the property management company that I was using. Became very close to the CEO, and I just said, hey, Mike, I need a reality check here, because everybody's saying to me, Class C is better in a recession. You've been in this business for 30 years. What do you think? And he just sort of laughed at me and said, just not true, Jonathan. So I was like, okay, good. I'm not a complete idiot. I reasoned this out myself, but the facts bear it out as well. So that sort of long-winded self-congratulatory pat on the back aside, so what is it that you're going to be looking for? Let's just keep on the topic of Phoenix. What are the things that the signs that you're looking for to tell you, okay, now's the time to get back in?
I think distress will play a big factor. Although I think on the distress side, we're almost of the mindset that once the stress is fully hitting the market, that will be the all clear sign to a number of groups out there. And make no mistake, there is significant capital still out there waiting on the sidelines to swoop in. I mean, you've seen it with rescue capital, quote unquote, the preferred equity that's just flooded in the market right now. There's just ample capital waiting on the sidelines. And the moment where we start seeing the waves of distress coming out, people are going to be calling a bottom. And once that happens, it's going to be set quickly, and there's going to be some decent upside over the next, call it year or two. So right now we're positioned, again, being conservative, but we want to get ahead of that wave. And we're seeing, sizable discounts in terms of pricing in that market. So that's one of the things we're looking for. If it's trading at a 30% discount to where the peak value was last year, that feels pretty good. On its own, it's not enough. So we're also looking at cap rates. But when you look at downside scenarios in past cycles, a 30% decline in market is typically what we've seen. So if we can get there already, we feel pretty comfortable.
And so how are you sourcing deals? Because, one of the things that's, everyone's talking about is the fact that not a lot of stuff is trading at the moment because everybody, no one who doesn't have to sell is selling, or very few people right now, because they want to wait out whatever's coming and still get their price, right? So where are you seeing these deals that are trading at these discounts that you're talking about?
A lot of them are off market. That is a very thinly traded market right now, just because what we're seeing in the off market space is typically the guys that have to sell, like you're saying, and they have a price. Oftentimes they were over levered, and once they get below that price, they don't need to sell anymore because they're saying, hey, we're gonna eventually have to give these keys back to the lender. But we are seeing opportunities in newer vintage spaces, potentially where they were out to market, call it 9 months, 6 months ago, and they didn't hit the pricing. And now they've kind of just been watching the market trend lower, slowly lower, albeit flat. And they've been more open to selling within, a certain price range of where they thought they would be previously.
So who are those sellers, and why are they not just holding?
I think there's still a certain degree of people that are selling because their debt's coming due. And surprisingly, if you bought a couple of years ago, you may not be in a position where you've lost equity, but if you have to refinance in today's market, you're actually going to lose cash flow because interest rates of where they are versus where their in-place interest rates were. So there's a degree of sellers that are still willing to sell because at the same time, and we say the same about ourselves, we don't know where the market is going to be heading to. So there's still a degree of risk out there. And if they have a gain that they're happy with and that can actually produce returns, why not take some chips off the table and sell properties?
Turning back to the Pacific Northwest, how are you feeling about that market these days? Is your analysis similar to Phoenix or different?
It's similar. It's changed a little bit because, like I said, when we went to Pacific Northwest, which is also another set of markets that I've covered for a long period of time, we went there because there was such a sizable spread in cap rate. And basically we looked at it and said we could buy in Phoenix at a 3% cap rate, or in Portland, again, non-core. So we don't need to talk about the downtown, but the suburban markets like Beaverton or Tigard at a 4.5% cap rate. And the argument is that it's just not going to grow as fast. And I totally agree that is probably a fact. This is not going to grow as fast. But when you look at a 3% cap rate versus 4.5% cap rate, that implied growth rate is 50% more. So while it might not grow as fast, I don't think that the Phoenixes of the world were going to grow 50% more than all these other markets. So we went there, and that's proven out to be a good strategy for us because while it didn't appreciate as much, it also means that the downside isn't as significant either. So it's kind of been what I imagine. We're not in this market, in these markets, but similar to the Midwest story, where they don't grow fast, but when times get tough, they also don't drop. So it's a safety play.
Are you still looking for assets in those markets, or are you more focused on elsewhere? I mean, with those markets meaning, I'm sorry, the Pacific Northwest.
We are more selective, and we still want to have somewhat of a cap rate premium versus some of our other markets. But we're actually very aggressive there still. We think specifically when I'm saying Pacific Northwest, it has been Portland and throughout Central Oregon. We are also big advocates of the Mountain West region. There's with work from home, there's been an influx of renters that have been able to move where they want to move. And so we're looking at landscapes and just saying, where's beautiful country? Where do people want to live? Where provides the outdoor amenities that nature can provide? And Oregon and the Pacific Northwest in general is probably top of mind.
Yeah, I mean, so what other markets do you like at the moment? So when you talk about the Mountain West, what specifically, where are you looking?
Right now, just because our portfolio is there, it's just throughout Oregon. If we were looking for new markets, I think Idaho would be a great market. I think Salt Lake City is a phenomenal market as well. We constantly have the conversation of expanding into there, and it probably will happen eventually. But we're happy with the markets that we're in right now, especially with adding in Phoenix. But those markets, they have good, like I said, demographics. They have good employment, and they have the outdoor amenities.
Are you at all concerned, with the markets that benefited from the work from home boom? Are you at all concerned about people being called back to the office, as there's starting to be a little bit of nibbling around the edges of that, it seems? How do you address that? Yeah,
it's a big concern of ours, actually, because I think that's going to happen. It's already, it's happening right now, but there hasn't been a large push, and there's been quite a bit of pushback from the employees saying, no, I don't want to do that, which is easy to do when employment is so strong that all the employees have more of a say. But the Fed's trying to weaken the employment market, and once that happens, employees will have the say again, and they're going to require quite a few people to come back to the office. So we're looking at it. It's why I would say that we would definitely be more aggressive in the Salt Lake City market versus the Boise market, because Salt Lake City is bringing the jobs themselves and the employers to that market.
What other markets do you like, and why?
I think we summarized it because we're, like I said, we're also in Tampa, but two of the major risks that we're watching today are insurance risk and property taxes risk. So that also promotes Phoenix, because Phoenix has some of the lowest insurance rates that you're going to find in the United States, and it's also got just like a cap on the property taxes, so it can't increase too much. So we are shying away from markets that have uncapped property taxes and environmental risks that are impacting insurance. So we're looking for quite a bit of a premium in markets like Texas and Florida, and we just haven't seen it yet. Florida went through one of the craziest insurance renewals that I have ever seen in my career, and properties for the most part have been able to sustain it. But we're talking about $2,000 a unit for insurance that they were able to absorb, but say there's another 25% increase now next year. It's just getting to unsustainable levels. And our ultimate goal in investing in multifamily is to avoid these types of risk. It's a safe let's not call it a safe asset class. It is a resilient asset class that leads to strong, steady returns over a long period of time. So we're avoiding the risks that work against that mentality.
I mean, so asking you a little bit more of a theoretical question about places like Florida. I mean, even if the assets have been able to sustain these crazy increases in insurance rates, that does hit their NOI. So what happens when they go to refinance, right? Especially with higher interest rates. I mean, what I know it's hard, but how do you sort of quantify that risk to those markets going forward?
Yeah, we looked at it, and it pains me to say this because I love Florida. I think that, if I wasn't living in Southern California, that's probably the likely state that I'd be living in. It's beautiful, and it's got a lot to offer. But we looked at it and we said, if insurance is going from it essentially doubled over the last 12 to 24 months. So call it, it went from $1,000 a unit in insurance to $2,000 a unit. That equated to about a 10% drop in value just because of your insurance renewal premium. So it's a small expense, but given the magnitude of the increases, it's very impactful. And like you said, that's factored into now your renewals. So there's no sign of relief there. We don't know what's going to happen yet in that market, and it's very well can increase further. So we have to be very cautious when we're looking and underwriting properties today.
Do you think that, sort of building on this question a little bit and sort of looping in, Texas as well, these markets have just been so hot over the last, number of years because of the demographics. But they've also just, as you mentioned, really suffered from, environmental risk, increased taxes, things like that. Do you think that that is going to negatively impact, those markets from an investment point of view? Do you think that people will start looking more places like Phoenix because of the factors that you outlined, just the lower operation costs there? Do you see any shift in focus in the investor, in the investor community based on those kinds of things? Or do you think it's still going to be like all in on Florida and Texas just because the demographics are so good?
I think it'll eventually shift. Now, I still think long-term, those are phenomenal markets. So I think it'll eventually shift, and that'll happen the more and more that rent growth flattens out, because in the past, rent growth has been so high, it's been able to make up for the expense growth that they've seen. But now we're heading into a world where rent growth is essentially flat, if not slightly negative over the last year, but our expenses are growing at inflation. So it'll have a cascading effect on underwriting your NOI when you have inflation surpassing your income growth, which is what we're seeing in those markets. So we are conservative, and that's part of the difficulty of the process. I could say that I love Tampa. I think Tampa is a phenomenal city. I would live there myself. Dallas is also top number one in the nation in terms of job growth, and I see why. They're attracting businesses and left and right. But ultimately, you have to look at the all the risk out there. And right now, I think there's more of a downside scenario in those markets because of taxes of insurance.
And what about, you mentioned earlier on about one of the things that you look for, one of the important factors you look for is affordability, right? So, and I'm assuming you mean affordability for the renters as opposed to affordability for you. But, one of the things I've been reading a lot about, say about Texas, is that the affordability of Texas has been eroding, right? So as more and more people are moving there, as you'd expect, supply and demand, right? The cost of housing is rising, particularly in some of those sort of darling markets like Austin and Dallas, what have you. How do you think that will affect, again, sort of investor sentiment in respect to maybe that market in particular, Texas?
Yeah, affordability has certainly been deteriorating. I think it's more of a national issue more than just the Texas issue or even a Florida issue, outside of possibly Miami, because Miami has gotten to almost on the same level as like San Francisco or some other markets. But that is ultimately probably fueling a lot of the new investments that we're seeing in the Midwest. But to address that is, after the Midwest, I'm not sure where an affordable market is going to be. And at the same time, I would point out that incomes have also grown pretty significantly over the last couple of years. So rent to income ratios haven't deteriorated as much as what people think. And being in San Diego, I've seen that probably better than anyone else, because rents have definitely surpassed what I thought would have been an affordability issue. We're well past that point, and even in Class C locations of San Diego, units are renting for about $1,000 per bedroom. So 3 bedrooms in even inferior locations of San Diego are now $3,000 a month.
Yeah, I mean, we see it here in New York too. I was just reading the other day, that I think the average rent ratio for even like a, not renter by necessity, but lifestyle renter is like over 30%, 35 or 38% or something, which is crazy. But the rents keep on going up. We had new records recently for rents after everybody said that New York was dead during COVID, and they just keep on climbing, right? So you see it everywhere.
Yeah, the only solution is to build.
Yeah.
Everywhere needs to build more. Some areas can actually build, but they still have hurdles in the way to kind of slow that down. New York and probably San Diego are two of those exceptions, though. It's just, the availability of land just makes it difficult to build. But other markets, they need to clear the path for more supply to come in. And, I think we will see significant supply over the next 24 months. But I think after that, we're going to have a supply shortage again, just given where interest rates are.
So the thing I wanted to ask you, the sort of quote unquote surprise question I had for you, maybe not so much a surprise after what we've been talking about, but so it's your belief that it's a much better time to be buying now than it was 6 months ago, and that may be sort of counterintuitive for a lot of people who are watching the market and seeing all the turmoil. So I would love for you to talk about that. Why is it a better time now to buy than it was 6 months ago?
Yeah, good question. And I have been pretty vocal about that. I would say that's probably a post you saw from probably about 6 months ago. So it's probably a year ago now. But to answer your question, of the early part of 2022, we were buying about 2 properties a year, which is slow for us. We want to be in a space where we're buying 4 to 6 properties a year, but we were very nervous about the market. And we were nervous about it because despite the growth that we were seeing from rent growth, we thought that was unsustainable. We saw that coming down significantly. And so when you're buying at 3 caps, even if you were expecting rent growth to be 50% to get you up to a 5 cap, it took a lot of assumptions to get to a 5 cap. Now, fast forward to today, we can assume that rent growth is flat, or call it somewhere between 0 and 3%, and we're buying at north of a 5 cap. So we're in a better position today with 0 rent growth than we were a year ago when we had to assume significant rent growth to get to the same number. Now, the outlier here is that we are in a different trend from an interest rate environment, and we could be at a 40-year uptrend on interest rates. That's not our thesis. We think that we've probably peaked out on where interest rates are going to go. And there is somewhat of a correlation between cap rates and interest rates. So we think that over the long term, we're probably at near the high of where cap rates will go. And if anything, they'll trend down from here. Maybe not significantly. We might not see the same cap rate compression that we saw from 2017 to 2019, and definitely not from 2020 to 2022, but we don't need that. We can forecast a property pumping out 3% rent growth, flat cap rate expansion, or even a little bit of cap rate compression, and we're going to hit the same returns as a year ago when we had to factor in 30% rent growth and cap rate staying relatively where they were.
What kind of returns do you underwrite to? What's your target typically?
Yeah, we have 2 strategies because our partners are syndication, like I mentioned, but we also have some JV partners. And it's not exclusively this, but typically we like to mold our syndication, and most of our investors, what they're looking for is more cash flow focused and long-term appreciation. So we'll come out with 7 to 10-year holds, have a heavy focus on tax advantage strategies, and also focus more on the downside. And really, they're looking at somewhere between, call it you're coming out day one at a 6% cash flow. So you're still surpassing where treasuries are today. And you're probably averaging between a 7 and 8% cash flow over the duration of that hold. They love that cash flow. A lot of them are retirees or living off that cash flow, and it's consistent, but yet there's still some modest appreciation over the long term. So they're probably penciling somewhere between a 12 and 13% annual return.
So I'm sorry, go ahead.
No, I was just going to say, most of you talk to, especially today, you're seeing groups have to come out with 20% returns and really push and motivate people to come out. We're building our syndication to just be slow and steady, and to trust us with our communication and the effort that we put with them, just to believe that here are our returns. Others are probably going to show higher, but ours are consistent. You can bank on them.
So that raises a couple further questions. So if you're looking at kind of 6% cash on cash in year one, that implies to me that you're not doing a lot of like a very heavy value add, right? You're buying more sort of properties that are stabilized, that maybe there's some tweaks you can do that get you to 6%, because usually in like a value add, people are forecasting 1.5, 2% rent, cash on cash in that first year, maybe even the second year while they're executing that value add. It's been hard to get deals that are going to provide that kind of cash flow that you're talking about in the first couple of years. So talk about the actual sort of investment strategy that you're pursuing.
Yeah, we look at it all. At the end of the day, we're looking at value add strategies and we're looking at stabilized strategies. I think a lot of times what people are looking for as on the sponsor side is just a story. And that story isn't always necessarily true in what is needed. For example, I mentioned I bought a property in Albuquerque in 2021. It was almost new construction. It was built in 2020, so it was about a year and a half old. And there was no value add upside to it. It was just buying at the right price, a new construction, limited downside. We closed it at a 6.5 cap, thinking, and we underwrote it saying, we're only going to get 2% rent growth because it was a slow growth market. And we're going to exit at a similar cap rate that we are today. And the returns were better than any of the other markets we were looking at. So we closed on that property. Fast forward 12 months, cap rate is compressed to a 375. In 12-month period, the total purchase price had appreciated 68%. and we sold it for 140% IRR. So that I think that just goes to show that sometimes the value add story, buying the opportunistic asset, comes with a lot of risk, and that risk isn't always warranted. It isn't needed to really produce the best returns out there. So we look at new vintage. If we're buying it right at a good cap rate, we don't need to have a value add story.
And what would you consider buying it right for like a new, fairly new construction? You're buying it from the builder. What's the cap rate that you mentioned you bought that one at the 6.5, which seems to be like a pretty good deal. You don't find a lot of those. But what are you typically targeting if say you're looking at a new build?
Yeah, I would say it's not something we're targeting, but coincidentally, it has been the developers that are still managing a property a year or two after they've built it that tends to provide good opportunities, because there's a little bit of management upside typically, not always. Sometimes you have developers that are very good managers, but a lot of times, especially if they're merchant local builders, what they like to do is build properties. And when they have to start managing the property, that's not what they want to be doing. So operations can deteriorate a little bit. So that's just easy upside that we look for.
Oh yeah. So then the second question is on that strategy. So if you're looking at more of sort of a slow and steady, I would call it sort of it's still a risk adjusted return, right? I mean, so it's a lower return, but the risk is lower as well. So it's a good risk adjusted return. But clearly, like the people that you're pitching your deals to are different, because they're not like, the person who's say 40 and looking to make as much money as soon as they can so they can leave their job or whatever it is, right? The dream that's always sold. You're talking about retirees, who are looking for cash flow or something like that. How do you position yourself? And who are you targeting as investors, if that's at least one of the silos that you're kind of investing in?
Yeah, our investors have a pretty wide background where they're coming from. We do have a lot of doctors in there. We have nurses. We have a lot of real estate professionals, because they tend to benefit more from the depreciation aspects. And then there's significant retirees just looking for cash flow. So given that, they typically aren't, other than people in real estate, the most sophisticated. So our communication with them is that we're just buying at a very good basis, below replacement cost. And if you're buying below replacement cost on an asset that is pretty new, it means that there's further appreciation likely, because growth in that market from a supply perspective isn't happening because sale prices are less than what you're building to. So when you have supply likely not to be significant going forward, it's going to lead to higher rent growth. Higher rent growth is going to lead to property appreciation. So we tend to be a little bit simpler depending on who we're talking to. If we're talking to some of our real estate investors, our overall strategy on buying stabilized assets is, I'm going to use cap rates as a term, but everyone has their own definition of a cap rate. So it's hard to really say what it is. But say you're buying a value add asset of 5.5 cap rate, and you think you're going to stabilize it with a return on cost at 6.25. You're going to add 75 basis points of value. Or we find a stabilized asset that's newer vintage, and it's a 6 cap just going in. It's also a six cap stabilized return on cost, because again, we're not going to a value add. You're not bringing it to the 6.25, but your downside protection is significantly greater, because you're not making a whole bunch of assumptions on where you think rents can be once you renovate these units, what you think the renovation costs are going to be. Or at least have a greater degree of certainty on the majority of your assumptions that you're making. So we'll look at situations like that. And if we are buying an in-place asset at a cap rate close to where we think we can bring value add assets, that makes sense to us all day long.
So tell me, we have a little bit of time left, but can you tell me a bit about how you built your business?
Yeah, good question. My background is a little bit different than I know a lot of people in the industry. I didn't transition from another career field. I've been in real estate my entire career. Even in undergrad, I got my broker's license, and I was working in residential sales through my undergraduate degree. When I graduated, I immediately went to one of the largest asset management firms in the Southern California region, PIMCO. I was part of their alternative investments and mortgage-backed security strategies. And that gave me a really good entry into the space. We were covering office, we were covering retail, we were covering multifamily. It was a broad net, really gave me great exposure on the whole commercial real estate industry. From there, I knew I wanted to focus on multifamily, because it's something I believed in. I believe in it specifically because it has all of the secular trends of any real estate sector behind it. And that, people need a place to live. It's one of the easiest things to say about multifamily. It's not an investment strategy on its own, but it does provide at least a strong degree of certainty that over the long run, multifamily is going to continue to appreciate versus like office space. You have to reposition an asset significantly for you to make a return there. If you're wrong in that repositioning, you're losing everything. So from there, I went to a graduate school at Duke, and I knew I wanted to work at a smaller shop. So I graduated there, applied all the way from LA South at local owner operators in the industry. And that landed me in San Diego with a pretty sizable firm at the time. They had about 500 million. From 2012 to 2020, we grew that portfolio to about 5 billion. And they focused exclusively on syndication, which was at the time it was unheard of that you could buy. Ultimately, we were buying $100 million properties. And again, this was syndication. And that was unheard of at the time. Syndication was historically believed to be mom and pop, friends and family money. And they proved out the model that that's not the case. You can compete with institutions with syndication model. But at the same time, I wanted to go even smaller. So I started Vanamore in 2017. There was some overlap there in the first couple of years. So I was focusing on buying small duplexes, triplexes, and single-family homes, and then ultimately spun off full-time in 2020 with the strategy focusing on the middle market, because as I saw their ability to raise equity grew and they're competing with institutions, they also became more of a placement, an equity placement shop where they had so much equity. You're not necessarily looking for the deepest or the greatest value add upside. You're looking at safe, secure assets just to place significant sums of money in. So we focus on the middle market. We will always focus on the middle market because that's where we see the most value add. And when I say value add, that's yes, it's through renovations, but also sometimes it's just management value add.
And I didn't ask you before, so what are the typical size deals that you've been looking at?
It's pretty broad. We'll look at typically between 10 million and even sometimes a little bit lower and 50 million. And that's what we define as the middle market space. But at the same time, that allows us to switch on the low end, which is almost predominantly mom and pop owners and private capital that you're competing against, to the larger end, which is middle market institutional equity, which over the last couple of years, we have seen the aggressiveness of those two buckets fluctuate quite a lot. I would say right now, most of the aggressiveness is on the smaller side. It's 1031 exchange buyers. It's private guys that just have a lump sum of money that they want to place somewhere, and we're seeing institutions on the sidelines. So we're seeing better opportunities on the higher end of that range. But rewind a year ago, 2 years ago, when institutions were very aggressive. You put any deal in front of an institutional partner and they wanted to do it, it was actually the reverse.
Well, I think we kind of run out of questions for you. This has been really interesting. Anything that we didn't touch upon that you would like to leave in the minds of the audience before we go?
This has been a great conversation. I'd love to be back on anytime. This has flown pretty well and this time has flown by. I would just say to any of your listeners, feel free to reach out to me, whether that's on LinkedIn is probably the most active social media that I'm on, but I'm on it pretty frequently and post quite a lot. So feel free to reach out to me on LinkedIn if you have any questions or just want to talk about the market further. And
do you have any, is there someplace they can go if they want to sign up on your investor list, join your email list or anything like that? Where's the best place for them to go?
Yeah, that's probably a good thing to add. We do have a website. It's vanamore.com, and Vanamore spelled VANAMOR.com. On there, you'll see our investor list subscription, as well as we put out a newsletter every month. Our next one will be coming out this week. So we like to share our thoughts there, and we stay active. Awesome. Well, Bobby, it was great meeting you today. Really had fun with this conversation. Love the way you think about multifamily, and obviously you have a wealth of experience. So I encourage everybody to reach out to Bobby and sign up for his email list and contact him on LinkedIn. And Bobby, I'll definitely be having you back on the show at some point and get an update on where you are. Yeah, it was a pleasure. Thanks again. Thank you.